I think one of the most common objections that I get when I'm talking about whole life insurance is from index universal life agents when they come back at me, because one of the things that I say about index universal life insurance is that you cannot rely on the current assumption category of an index universal life policy. It's almost guaranteed that it's not going to perform that way. Now, what they do is they come back at me and they say, well, Chris, if you don't do that in IUL, you can't do that in whole life, because I spend a lot of time talking about the current assumptions in a whole life policy. So in this video, what I'm going to break down is exactly why I'm completely comfortable talking about the current values or the current assumptions inside of a whole life insurance illustration, and what I walk my clients through when I talk to them about really understanding what they're getting involved with. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and in this video, we're gonna be talking about current assumptions category in a whole life insurance policy. I know that's not like the sexiest topic in the world, but I think this is one of those things, if you're looking to buy a whole life insurance policy, this is one of those things that you need to understand. And what I'm gonna do in this video is I'm gonna break down not only why I'm more comfortable now than I've ever been that a whole life illustration is actually gonna perform the way it's sold, whereas the past 40 years it hasn't, and I'm gonna go through why that's the case. But I'm gonna talk about the difference between index universal life, whole life insurance, and whole life insurance, I should say, so you can make an educated decision as to what the best option is for you, and we'll go from there. So I think the best way to do it is for me to just hop over to my screen here, and let me zoom in on this fun little sheet. This is a snapshot of an illustration. I've got this here, not to get into super amounts of detail, but to just talk about what this is. So what we have here is a company that has a 5.2% dividend rate. But remember, this is not a gross, or that is a gross dividend rate, not a net dividend rate. That is the gross dividend rate before all expenses, mortality charges, all these different things, they go into it. Now, just to kind of give a little example of what we're talking about here, just how this illustration is set up, we got $110,000 going in year one with a $10,000 a year premium after that for 15 years, and then it drops down to $8,572. You could see here, based on the death benefit, we used a term rider for 15 years. So that term rider could be lengthened. For instance, we could have made it a 20-year term rider, and that death benefit would have gone to there. Could have been a 30-year term rider, it would have gone out to 65. But for the sake of this video, it is 15 years, and that is what it is. You could see the death benefit. I get a lot of questions in these videos. Why does the death benefit drop off there? Well, the death benefit drops off because the term insurance rider that was utilized to keep this in place, to be able to fund this policy to these levels, basically, effectively, to be able to get this $100,000 into the policy in year one without becoming a MEC, right? We don't want these ever to become a modified endowment contract, so we had to use that term rider to get there. Now, let's take a look at this. This is a pretty awesome policy, right? So you got $110,000 going in year one with $101,000 of net cash value, almost $102,000. So we're basically looking at about 91% liquidity or net cash value in the policy right here, year one, right? Year two, you could see we put in this $10,000 in premium, and the policy grows here by $10,953. So it's already growing by more than our annual premium amount in year two. That is really, really special to be able to pull that off inside of a whole life insurance policy. Now, when we talk about this, this is what I'm talking about. That when a lot of people go, all right, what do we have here? I'm gonna clear these strokes a little bit here and get this out of here. So now that we got that basic foundational understanding of why I designed this policy this way, just for the sake of argument in this conversation, what I wanna talk about now is the guarantees versus the non-guaranteed assumptions, right? So you could see everything over here to the right of that line that I just drew, everything to the right is a non-guaranteed assumption. So it's going based on 100% of the current dividend scale. What does that mean? Well, if the dividend is 5.2%, this is saying as long as this company pays a 5.2% dividend and they pay it every single year, then these numbers are gonna be what happens. Now, is there a guarantee that they're going to pay a dividend every single year? No, of course, the answer is no. There's no guarantee. Dividends are not guaranteed. The guarantee over here is assuming a 2% guarantee. Now, these numbers on the net cash value on a guaranteed basis are, they're based on this 2% number, and they're not quite as good as you'd have in a banking account. From the perspective of, you look at this, you have a cumulative premium of about $250,000, and your net cash value is only $197. So on a guaranteed basis, you're behind the 8 ball. Now, there are other companies that have better guarantees that we represent. I personally don't worry about the guarantees in these illustrations. It's nice to have them there. I'm a big believer, you got to think about what's the upside, what's the downside, can I live with the downside? And when I look at this and I go, all right, the worst case scenario, I can live with that. I can live with that 53,000, 52.5 in liquidity crunch there, or loss of cash value. When we look at the permanent life insurance element to it, and the living benefits and all those things that come with it. Plus the facts are, this company has paid a dividend 120 straight years, right? They've never missed paying a dividend to the policyholders, right? So that's, I think, a really important thing. Now, so this is why I say I don't worry about this, the guarantees. There are people that do, and if you are one of those people, then this company is not for you. There's another company that we use that has far and away better guarantees, where this number on the guaranteed would be bigger than the cumulative premium on a guaranteed basis at that point in time. But that's another conversation, another video for another time. What I think is important to understand now, getting to this, is that when we look at the 5.2% dividend, this is the current dividend scale. Historically, that is the lowest dividends have been in over 80 years in these policies. So when we look at this and we go, all right, well, why do people have this negative connotation? Because with whole life insurance, the answer is because when we look at this 100% of current dividend scale is the assumption for this column, right? If we look at that and we go, all right, what happens? Let's talk about a couple variables here. So what would happen, I'm gonna go over here. What would happen, well, I guess I won't even ask it as a question, I'll make it as a statement. Here's what happened. Back in, let's say, 1990, the dividend scale, the current dividend scale right here, the dividend, I'll just write div for dividends, was about 9.5 to 10%. Okay? So what happened was, if I were to run this illustration in 1990, this illustration would show, assuming this 100% of current dividend scale, and the current dividend scale was at, if it were at 9.5%, well then it's gonna get bad, because what happens is, as time goes on, I'm not gonna leave that 9.5 number there so nobody's confused. As time goes on, as the interest rate or the dividend rate went down, as that happened, what happened there is that the policy actually performed worse than the current scale, because the dividend scale reduced. Therefore, the policy on the current assumption side right here went actually performed worse than was shown on the illustration. And this has happened. This has happened ever since 1980, because like what's happened here is that you look at this, in 1980, dividend rates were up near 20, or the federal funds rate, I should say, was up near 20%. And they went down all the way to 2009, and then 2009 to 2020, 2022 actually, they all stayed near 0%. This has put stress on it. This is why Section 7702 was updated. This is why the guarantees and all the whole life insurance policies were changed from 4%. Now they can go anywhere from 2 to 3.75%. This is the new differentiator for a lot of companies. The question is, do you want to focus on higher guarantees, or do you want to focus on low guarantees and be able to have higher dividend payout? The lower the guarantee, the more flexible you can be on your general fund, the less reserves you have to have, the less stress there is on your general fund to perform at a certain percentage. But the good news is that these rates the 0% rate is going up now. So I'm going to erase this so I have some room to work. So the good news is that 0% rate now has room to go up, and we're already at whatever, like 5.5%, right? So that's a good thing. This is the highest rate we've been at from a federal funds rate perspective since like 2007, I think, in that range. So when you look at that, that's a really good thing. It's the highest federal funds rate we've had in 15 years, and that is taking stress off the general funds, which is then taking stress off the dividend rate, which is going to allow them to do a higher dividend scale over time as rates continue to go up. Now, what's happening here though is that if we look at this, and I just want everybody to really understand this, at this 9.5% to 10% rate back in, say, 1990, let's just call it, if that was 1990, and as rates went down, as rates go down, dividend rates, let's just say green is dividend rates go down as well. And then what happens is that means this will perform worse. This net cash value column will perform worse, okay? So that's important to understand that that's what's happening here. Now, on the inverse of this, we are at the lowest rate we've had in 80 years. So now what happens is as we hit this increasing interest rate environment here, rates are going up, dividend rates will go up as well. Dividend rates typically trail the federal funds rate and trail the markets a bit because all fixed assets follow it. And if you understand anything about whole life insurance companies and their general funds and how they manage them and all, the bottom line is you're looking at this from a perspective of the rates are going to go up. And if we assume that the company is going to pay a dividend scale, and we look at this assumption that the 100% of dividend scale is assumed, well, this is the lowest dividend scale assumption in 80 years. So if that 5.2% goes to 5.5%, well, now all of a sudden, the numbers in this column, all these numbers will start getting bigger and bigger as soon as the dividends go up. So for the first time in 50 years, we're able to look at a whole life illustration. Why? Because we're able to assume that it's actually got the real viable potential to outperform what you are seeing on an illustration. Am I saying it's guaranteed to perform better? No, but I'm saying it's got a viable chance to perform better than you're seeing on the illustration. And why is that? It's because of the fact that while we were living in this declining interest rate environment, and so they were always going to perform worse because the dividends were going down, so therefore the current dividend scale was going to go down, therefore the production and the performance was going to be worse than was illustrated. Now we're in an increasing rate environment, and so it's got the potential to be better as dividend rates go up. That is the variable. If dividend rates go up, so you have to ask yourself, what do you believe? If you believe dividend rates will go up, which by the way, I'm going to just say, I do believe in my heart of hearts that dividend rates will go up. So if I can't make promises, you have to make your own judgment on what you believe to be true and align your money with your values and your beliefs. And so if you believe that, you have to say, well, what do I think will happen? And that's why I think right now is probably the best time and opportunity to buy a whole life insurance policy that we have ever seen, at least in my generation, in my time here. This is the best opportunity to buy a whole life insurance policy that I've ever seen, because I think the opportunity for them to perform amazingly is like nothing we've ever seen. Now, I guess I want to be careful with how I state that, because when I say it's the best time ever, the bottom line is it's always a good time to buy a whole life insurance policy. I would say it's probably the easiest time to sell a whole life insurance policy now, because we have an opportunity to be able to like fix the reputation of the product that has been misrepresented. And when I always say I hate when people sell off illustrations, I get it. You gotta use illustrations as a tool to be able to communicate with people, to be able to show people what the potential is. But you need to make sure, if you are utilizing the illustration, that you kind of go through the process that I just went through and explain to people how these dividends work, what the current assumption is all about in a whole life policy. And when I look at this, I can look at this in like I said, in my heart of hearts, I can have confidence that I could talk to somebody and be like, listen, there's no guarantees, but there's a real high likelihood in my belief center that this will outperform what you are seeing. Now, you have to come to your own conclusions. There's no guarantees about that one way or the other, but when you understand how these work and what impacts the dividends and what impacts the performance of the policy, you have to decide what you believe to be true. Now, inversely, When we look at Index Universal Life, and I'm not going to pull up the illustrations on that because it's very pretty much straightforward. What I want to do here is I want to show this, and I'm gonna go through here. I'm gonna spend a little time talking about Index Universal Life and how they work. So basically, with Index Universal Life, let's take this $10,000 goes into a premium. You pay a premium. There's going to be some cash value, and that cash value, let's say you got $10,000 of cash value in a policy, right? And that $10,000 is going to kick out a return. If the budget, or if the general fund return is 4%, it's going to kick out about $400. $400 is 4% of the $10,000 here, right? So that's important to understand. So this is your option budget. When you look at the options budget here, now we have to go and we have to buy call options with it. So the bottom line is this performance of these two things and the variables is like, A, what's the options budget going to be? B, what is the call options cost? What are the costs of these options? And C, like, how is the S&P actually going to perform? Or like, if you have those three things, those are your three variables that actually impact the performance of an IUL is what's the options budget, options cost, and then S&P or whatever index. I'm just gonna index performance. Now it could be a different index, but that is what it is. Ironically, the S&P 500 index performance has actually the least impact on the actual overall performance of an IUL policy. And this is one of the reasons why when I look at the current assumptions, let's say they're saying it's going to be 6.4% assumed return on an IUL. Well, let's talk about that. In the assumed column, they're going to look at that and they're going to go, all right, this is a conservative assumption, because they're going to look back and they're going to go, oh, we got a 30-year historic look back of this S&P index, and it's averaged 7.1%, right, over that time for the look back, right, in that situation. So they go, oh, 6.4 is a really conservative assumption. Well, that's got nothing to do with it, because really it's the options budget and the options cost. What they do there is they figure out what are the cap rates, par rates, participation rates is what that stands for. And then maybe spread charges. I'll just write spreads. And these are all things that ultimately they can change, because it doesn't matter how the S&P 500 index performs. If these two things get more expensive, they're going to reduce cap rates, par rates, spread charges, so you get to participate less in this. This is the measuring stick, but this is actually what leads to the costs and what leads to the performance. And ultimately, because you are not in the S&P 500, you are participating in the S&P 500 through an options-based strategy, and you have to understand how this options-based strategy plays into it. And when you realize that this 6.4% from an options-based strategy, and when they show it has really nothing to do with how it's going to perform, and they show you these 7.1% historical lookbacks on the S&P 500 saying that this 6.4% is conservative because of the comparison of the two, and you realize that it's an apples to oranges conversation, and they shouldn't even be allowed to have that conversation in the same conversation, because it is literally not the same thing. And when you look at this, and this is one of the reasons that I created the Index Universal Life Challenge, look up hashtag IUL Challenge on YouTube or Instagram or anywhere, TikTok, and I have videos that go out on this topic. And all I can tell you is that nobody has won. It's been over a year, almost a year and a half, and I've got over 1 million views on these videos, and not one IUL agent has been able to show me an IUL in-force illustration that has outperformed the illustration that it was sold with over a 10-year period during the greatest bull run of all time. That if those are conservative assumptions, the S&P had the greatest bull run of all time. So a product that sold with upside potential and downside protection did not allow you to really get any gains, any participation in the upside of the market. If you didn't get any upside potential and participation in the greatest bull run of all time, what's it going to look like when times go bad? So when people go, oh, well, I could do the whole life challenge. Well, guess what? That's the same deal. Everything I just explained to you about how whole life works, declining interest rate environment, declining dividends. Of course, whole lives didn't perform well either compared to illustrated values, but that doesn't mean they didn't perform well. You got to look beyond the surface. You got to look at why and how these things function internally. And then when you look at the future, you realize that moving forward, the picture is much, much brighter for whole life, much more dim for index universal life. And ultimately, what you're looking for is a product that you can control the variables and that the rules are set up in your favor. And that is one of the most important elements that I think people need to consider when choosing between the two products. So if you have any questions, hopefully that makes sense and you find value in it. If you have any questions, please comment in the section below. I'll do my best to engage with every single comment. I'm actually gonna start doing videos every single week where I go through live and I respond to comments. So if you have some good quality content in there or comments that you think would be answered really well on a live format, go ahead and comment and I will do my best to answer it. And that's it. I'm back in my studio. This is my first video back in the studio since I got back from my trip to South America, and excited to be home. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.